If banks no longer control money, then who does? It's a question most people never ask because for generations the answer seemed obvious. Governments issue currency. Central banks manage the system. Banks distribute credit. But that mental map belongs to another era. Today, money does not move because a law is passed, it moves because confidence shifts, because liquidity appears or disappears, and the power to decide that no longer sits in one place. It exists across a layered system, quiet, technical, and deeply misunderstood. This is not a story about secret meetings or hidden rulers, it is about structure. And structure is far more powerful than intention. The old illusion of control: most people still believe money is controlled from the top down. That governments decide spending, that central banks decide inflation, that markets respond afterward. This belief feels logical, but it no longer describes reality. Governments today borrow continuously. Central banks react rather than command, and markets move faster than policy ever can. The result is an illusion of control. Rules exist, laws are written, statements are issued, but the system responds to something else entirely: access. Control is not ownership in the modern financial system. Control does not come from ownership, it comes from access to liquidity. Who can borrow first, who can borrow cheapest, who can roll debt indefinitely, and who cannot. This access determines which institutions survive crises, which assets recover fastest, which losses are absorbed, and which are erased. The system is not controlled by those who hold money. It is controlled by those who can create, direct, and withdraw liquidity at scale. Layer 1. Liquidity creators. At the foundation of the system sit the liquidity creators. These are not politicians, they are not investors, they are institutions with the ability to expand balance sheets instantly. Central banks. When stress appears, central banks do not debate ideology. They respond to system risk. They expand reserves, open emergency facilities, backstop markets, signal support, but central banks do not decide where liquidity flows. They only create the conditions for it to exist. This distinction matters, because creation is not control, distribution is. Swap lines. The hidden global backstop. One of the least understood tools of modern finance is the swap line. When global stress appears, central banks quietly exchange currencies with one another. Dollars are provided, liquidity is stabilized, markets are calmed. This system does not involve votes, it does not involve public debate, and most people never hear about it. Yet it determines which countries maintain financial stability, and which face pressure. Swap lines reveal a simple truth: global money is not controlled nationally, it is coordinated. Layer 2. Liquidity distributors. Once liquidity exists, it must move. This power belongs to a smaller group: primary dealers, large financial institutions, market intermediaries. These entities sit closest to central bank funding. They decide which markets receive support, which assets are financed, which institutions gain breathing room. This is not favoritism, it is design. The system flows through nodes that already exist, and those closest to the source always benefit first. The repo gatekeepers. At the heart of modern distribution is the repo market. This is where institutions borrow short-term cash using collateral. In theory, repo markets are neutral. In reality, they are selective. When conditions are calm, repo flows freely, leverage expands, risk hides. When stress appears, collateral requirements rise, haircuts increase, funding dries up. This is how control is exercised, not through commands but through conditions. Layer 3. Liquidity amplifiers. Above the distributors sit the amplifiers. These are institutions that do not create liquidity but magnify it. Hedge funds, private credit funds, structured finance vehicles, derivative markets. They borrow short, they invest long, they leverage confidence. As long as funding is cheap and rolling, the system appears stable, but amplification cuts both ways. When liquidity retreats, leverage turns fragile instantly. This is where modern crises accelerate. Private credit as power. Private credit is not just an investment class. It is a control mechanism. When banks retreat, private credit advances. It sets terms. It prices risk internally. It operates quietly. Companies that rely on private credit do not answer to depositors, they answer to capital providers. This shifts power away from public oversight toward private negotiation. Private credit does not replace banks, it replaces their restraint. Why markets obey signals, not laws. Markets do not wait for legislation. They respond to signals, a hint of support, a subtle shift in tone. An emergency facility quietly extended. Confidence moves faster than rules. This is why official statements matter so much. They are not communication, they are coordination mechanisms. Confidence is the real currency. Money today is not backed by gold. It is not constrained by reserves. It is backed by confidence in continuation. Confidence that liquidity will remain available, markets will function, losses will be contained. When confidence holds, leverage is invisible. When confidence cracks, the system tightens instantly. This is why modern control is psychological as much as financial. Who benefits from this system? The system rewards proximity. Those closest to liquidity recover first, borrow cheapest, accumulate assets during stress. Those further away experience Higher costs, delayed relief, permanent damage. This is not corruption, it is gravity. Liquidity flows downhill, toward institutions already positioned to receive it. Why democratic control is limited. Many ask why governments do not simply change the system. The answer is uncomfortable. Modern states depend on it. They need continuous borrowing, stable markets, rising asset values, interfering with liquidity flows, risks, confidence, and confidence is fragile. So the system persists. Not because it is perfect, but because alternatives are more dangerous. Control today is exercised silently through funding, access, collateral, eligibility, market inclusion. Institutions that align with the system thrive. Those that don't find funding expensive or unavailable. This discipline requires no enforcement. Markets do the work themselves. Why control is diffuse, not centralized. There is no single controller. That is the point. Power is distributed across central banks, intermediaries, markets, confidence networks. This makes the system resilient and dangerously opaque. When something breaks, blame scatters. Responsibility dissolves. Why crises look different now. Modern crises no longer begin with collapse, they begin with hesitation. A market pauses, liquidity thins, confidence questions itself. By the time panic appears, damage is already done. This is why crises feel unexpected. They don't explode, they evaporate. The paradox of modern control, the system appears more stable than ever. But stability depends on continuous motion. It cannot stop, it cannot rewind, it cannot admit fragility. This makes control powerful and precarious. The uncomfortable truth: money today is not controlled by law. It is controlled by access, speed, confidence. Those who manage these forces do not rule openly. They don't need to. The system responds automatically. The open question: so who really controls money now? No one and everyone. The system governs itself through incentives, and that is both its greatest strength and its greatest risk. Because when control depends on confidence, and confidence depends on belief, the real question is not who controls money. It's this: what happens when confidence breaks? Part 3 coming next.